Good afternoon and welcome to this first afternoon or second afternoon session, and we're going to talk about risk, how to marry risk and yield, because there's a perception that the higher the risk you take, the bigger your return will be, and that's not always the case. It's not always correlated because, for example, if you receive a return of say 8% on an investment for a particular year, that return can be significantly better than a 10% return on another investment because the 8% was achieved at lower risk. So we're going to talk about how to look at risk in a portfolio, how to look at it in an investment strategy, and I think not too many people think about risk enough before they take investment decisions. And I've got a very esteemed panel, Anthea Gardner, she's from Cartesian Capital, Jeanette Marais, CEO of Momentum Investments, two absolute experts in this field. You've also been in trenches for many years, and let's just start off with risk. How do you think investors, Jeanette, should look at risk when they start to plan, they want to build a portfolio, they want to get started in the investment world?
Ryk, I think they should only worry about one thing, and it's actually the risk of losing capital. Because actually, I think sometimes when people look at funds and think whether to invest in them or not, they look back at kind of past returns. But it means absolutely nothing, even if you get those exact returns, if you cannot stay in that fund. And therefore, I mean, my recommendation would be look at the fund fact sheet of the unit trust fund. Let's say it's a unit trust fund that you're thinking of investing in. And look at, there's something that we put on that's called a drawdown rate. The drawdown rate actually is an indication of, over a period of time, what the maximum drawdown, the maximum losses were that fund experienced. And forget about that past return. Look at that drawdown rate. And if you cannot stomach to lose that much of your capital, it's not the fund for you.
But if you look at a fund and you evaluate whether you want to invest in it, that's not the first thing you look at. So is the risk the potential drawdown of the fund, or is it the underlying investment?
Well, I think the point is this, that, and actually I brought some numbers, so I'll look at my notes just to, kind of highlight it and get it, specifically right. 3 types of funds that we know very well. SA equity funds, I'll compare that to what we call a multi-asset low equity fund. It's kind of a stable fund if you want. And then the last one is an income fund. And I looked at numbers right from just before COVID to now. Now, here are the fascinating numbers. SA equity on average, and these are the ASISA unit trust funds in South Africa, on average returned 6.7% from pre-COVID to now. Multi-asset low equity returned 5.3%. That's only a 1.4% difference over this almost 3 years. And income funds returned 6%. But the maximum drawdown of SA equity funds was 33%, multi-asset 13%, and income funds only 4%. So on the one hand, if you were to look back at past returns, you might have been tempted to pick the SA equity because it had like almost a 1% better return. But what you would have missed is that the drawdown was in an equity fund over the same period. You could have lost 33% of your money. If you stayed in, it recovered. Took 270 days to recover. But can you stomach to wait 270 days for the recovery? So what did people do? That severe kind of fall in the market came, they took their money out, and they never came back. So not only did they put that kind of capital loss into a permanent loss, they've also not managed to be part of the recovery. And I think that, for me, is the definition of risk.
Some interesting numbers, and I think it's to the point. The fixed income return may be slightly lower than the equity return over a 3-year period, but and it's at a lot less risk.
Yeah.
Anthea?
So I definitely can't disagree with Jeanette. I think your primary risk is the risk of losing your money. So if you invest your money and that investment goes to zero, that's your primary risk, which just nobody wants to stomach. And then the second one really is about volatility, and it's personal risk. So when the market drops, have you got the temperament or the capacity to stay in that fund and wait for the recovery? So can you sit out the 270 days that Jeanette quoted? And that's risk, and that's about everybody in a personal sense. So you can't generalize and say, well, everybody should look at exactly one risk number and that's it. I think it's very personal. And it really goes around your personal cash flow, right? Also your desired versus your required return and your time horizon of investments. And so for me, it's kind of, you'd have to look, when you're investing for yourself or even a group of people, what the ability to stomach volatility is, really more than anything else. So there's no point in saying, okay, well, my required return is an equity-like return, but if the market falls 30% in March 2020 like it did, then I have to get out of it. If you can't stomach that, then you should be expecting possibly a lower return, the money market return maybe, which is less volatile, consistently yielding.
But does volatility impact risk?
So if you're talking about personal risk and the ability to sit through volatility, then absolutely yes, risk. Then you would look at it that way, right? So so in hedge funds, for example, when we manage hedge funds, we look through kind of what are the ratios, what are the Sharpe ratios, where is the volatility versus the risk? What are you paying in peace of mind, quite frankly, because volatility is lack of peace of mind, I'll tell you that, for the risk or the return that you're getting. So is volatility risk? Yes, I would say pretty much yes.
I just want to quickly go through the asset classes and my perceived risk element attached to those. Cash bonds, fixed income investments, low risk, your money is safe in the bank. The only risk is whether the bank goes bust. Then property, good income. There are fixed assets, tangible assets behind fixed property. That is still conservative, maybe slightly more risky than equities, high risk, and I think many asset managers and especially also financial advisors, when they say, listen, you need to be in risky assets, they refer to equities as an asset class because you can have different risk profiles within that asset class. And then commodities, crypto, commodities maybe not, it depends on how you invest in those. Gold, for example, can be very volatile, doesn't provide with the income, but it's a perception. I see you frown at me, Anthea. So how cast in stone are those perceptions of risk attached to those asset classes? Is risk attached to fixed investments, cash investments? Is it so much less risky than the others?
No. So again, I think it's about volatility and how volatile these are, and that's what you use to measure your risk return profiles, right? So what we do in investment circles is we use the efficient frontier, and that basically measures exactly what you're talking about, the volatility versus the return, and how much volatility or sleepless nights are you getting for the return you're getting, and what would your optimal return be for the amount of risk, in inverted commas, that you want to take. So for I want to sleep easy at night, and I don't want to worry that tomorrow I'll wake up and my portfolio is down 10% because I may need the cash immediately. That's what it's all about. Now, what's interesting about kind of the risk metrics or the risk number that you've put on each of the asset classes is that it's historic. So as asset managers, you have to manage forward because you have to know what's coming, but you have a rear view mirror. You don't have a crystal ball. So all you have to do is take the historic returns and the volatility of those asset classes and build the best portfolio you can. So I think the great thing kind of about what we do or our industry is that we have built lots of different portfolios. So you can look at a money market or a growth or an aggressive or Rig 28 or a pure equity or pure commodities portfolio, and you can combine your risk according to your risk profile. What is your term horizon? What is your asset base versus your liabilities. And that's quite an important one. I think people forget that because you can only make money when you're investing. You can't give me nothing and say, please make a return for me. It's kind of, that's how it is. And also, what are your future liabilities? So for a pension fund, that's a big liability in future because you've stopped working, you're going to draw down, you're going to stop investing money. And that's risk, right? So your asset base to generate enough returns or to grow your pool of assets to cover those future cash outflow liabilities is all part of kind of what you should be thinking about in your risk equation. So when back to the efficient frontier and talking about these risk assets and how you build your personal portfolio is very important to understanding your personal situation and where you want to be and how you want to be.
But that's difficult to do because it's based on perception.
It's your perception. It's your understanding of your cash flow requirements. So you know that you want money next year, for example, to put down a deposit on a house. You need an asset base which you can easily access. You need that cash. You need to be able to access the cash in a year's time. What you cannot afford to do is then put it in a portfolio or an asset class that is very volatile because next year could be exactly when you need it. The market could be down 30%.
Time horizon is a critical component
Absolutely.
of risk. Yeah.
But I want to take it one step further, and I think this is what for me is so fascinating. And you know, Ryk, we've had so many conversations about this. It's the richest topic. I now have a team at Momentum, it's all they do. And that is that lots of people will look at it and say, my time horizon is 20 years to get to retirement. But nobody put their money in and then stick to that for 20 years. Because tomorrow the market fall by 33%. And that's where behavioral finance, that personality comes in. Certain people, I suppose, could look at that and say, been there before, leave it, it will come back. 90% of investors will get out because they cannot handle the emotional stress of that. So yes, I'm still invested for 20 years, but I make short-term decisions that is actually based on the emotional kind of stress I'm experiencing because I see my hard-earned money slip away from me. And that is the worst time ever to make, that kind of a decision. So yes, we have plans, we have dreams, but those dreams turn into nightmares if things happen to us and the volatility causes us to then make almost counterintuitive type decisions. You know me, I will always, I listened to what Anthea said here and I was like, I'm in this industry every day of my life. I need someone to advise me on that combination of risk and volatility and efficient frontier. How does a normal person know that? And then that kind of behavioral coach, advisor on the way to say, stop. Your plan haven't changed, therefore let's not make any kind of rash decisions, get in, get out, try and time the markets and all of that.
What are your views on risk perception? That is when you evaluate an opportunity, there's not a tangible risk indicator you can use, a measure you can use. So how do you look at risk and how do you attach that risk? You use the term risk formula, risk equation. How do you implement that? How do you attach the risk factor to that?
Well, look, maybe I'm simplifying it too much, but my world is with retail investors, normal people out there every day, and you try and almost get away from jargon and so on. So my investment team would be able to have those formulas, and they call it the risk premium that they're willing to pay, which is that kind of balance between risk and return and so on. A normal person like me with my own money, I can't do that. And I think for that is where, firstly, the normal things we say, get an advisor to help you, make sure that your portfolio is diversified. All of those asset classes that you started off with, I think a proper long-term personal portfolio should have combinations of those in, so that when the one does fall 33, there's another one that actually doesn't fall. And eventually it does balance out to at least just help you. So for me, risk is not how these things fall. Risk is whether my client have the ability to stay committed to that portfolio and can emotionally handle to stay in, because that's over time how they're going to get the returns.
Yeah, it's like a fun fact sheet. There's always that risk
drawdown.
Yes, and then in the green, yes, this if it's an equity-based fund, it's in the red, and if it's more cash-based, it's in the green. Do you attach value to that?
Oh, absolutely. I do, because even though, as you say, it's difficult to find an absolute risk number. So what is my risk number versus your risk number, right? Yeah. But I think you have to look at it, you have to attach something to it. You have to understand that the volatility of the fund is much higher in an equity fund or commodities fund than it would be in a money market yielding or flexible income or some sort of income fund, right? The other risk, of course, is what you then have to look like once you've decided I am a high risk taker because I can sit through the volatility, right? That's kind of really, in essence, what we're saying, is that I can handle risk if I can sit through volatility. Then the next question is desired versus required return. Now, a lot of people, I forget the number, Ryk, but a couple of years ago, I looked at the Financial Planning Institute kind of article, and it was a crazy number, like 97% of South Africans retire without enough money to get through retirement. And so they then said, if I'm not mistaken, that you need 11 times your final salary to retire comfortably. So, sorry, I know I'm saying this live streaming, but my numbers might be a bit wrong. But think about that, just as an example even. So your required return is that you need to know that if you're making R1 million at the end of your working life, you need 11 million rand to get through your retirement. That is a required return, right? Now, a desired return is a whole different story, because we all want 100 and odd %, right, per annum. so that's kind of what it. So I think part of what Jeanette is trying to say is that you understand these drawdowns, and you understand maybe you can't sit through the volatility, but maybe teach yourself to. So maybe understand that if you are going to take, and historically, again, equity returns have been higher, or private equity returns have been higher than, say, a low risk, low volatility, maybe I should start saying that rather, low volatility fund. And maybe you need to take that risk. Maybe you need to understand or train yourself to sit through the volatility and increase your risk number. So I don't know, maybe Jeanette will know better, if there is a perfect risk number that you can use to calculate it. And I've seen some financial planners go and sit through it, and they'll sit with questionnaires, and they'll sit down and score you accordingly. And I don't think there is, but that is why I would say the best way to probably overcome or to understand your risk is to know that down the line I am going to need X amount of money for a house, X amount of money for education for the kids, for retirement, for holidays, for repairs if my cylinder bursts. So just, and be very realistic about, I can't say quantifying, because we're just right now saying that it's not quantifiable, but understanding what your cash flow is going to look like in future.
Yeah. I want to implore people, send an email to events@moneyweb.co.za, ask questions. I see there already a few has come through. But before I get to those, risk is not homogeneous. There are different types of risk. And you get risk related to companies. If you invest in equities, the company can go bust. Steinhoff, Tongaat, there are a few examples of those. You get opportunity cost, which is actually one I don't think many people think. So you invest in Fund A, but it does really poorly compared to Fund B. Volatility we've spoken about, and then also liquidity risk. You have an asset, but you can't sell it because just no one wants to buy it, and that also poses a risk. How do you think you should approach all these risks? How do you take them into account?
I want to respond to the one you mentioned last, that kind of liquidity risk, but I want to add another one. The liquidity risk is, for instance, Ryk, you get this all the time. I listen to you Friday nights on the radio, and like just about every week, someone will ask you, should I invest in property or should I invest, in unit trust funds or whatever, EFTs, whatever, or ETFs, ETFs, anything like that. That's liquidity risk, is that if you buy property and you need the money, you are dependent on finding a willing buyer, the time in the market might not be right. So that's liquidity risk, is that you have capital but it's tied up somewhere. And I mean, it's much wider than just property, but I think it's such a good example because we often get those questions. There's another big risk that people often forget about. It's the risk of inflation. If inflation risk is a very real risk, for the last, 10 years or so, on average inflation, let's say, and then there's arguments about what's real inflation and what not, but let's just use the official number, was just over 5%. Now, the point is that you need to get at least a constant 5% return over a period of time to protect your capital. Otherwise, the buying power of your capital goes back. And I want to share with you a very interesting number. I've looked at, so we have an investment platform, we've got over 300,000 clients on it. So we use that as the data to do this study. And over the last 10 years, 88% of our clients invested on this platform got less than CPI plus 4% return. CPI plus 4, okay, so let's say that's 9. If it was 5% over the period, it's 9%.
Just say that stat again.
88% of clients on our platform, on average. So of course, you know how the world of averages work. Some got more, some got less. But on average, got CPI plus 4 or less. Only inflation plus 4%. Only 12% of our clients actually had returns of CPI plus 5 and more. Now, imagine you are a client in a living annuity.
That's not a function of the performance of the funds.
It's a function, it's a combination of, because over 10 years, funds have performed much better than that, right? It's because of the behavior. It's because clients constantly switch. The switching behavior between just when COVID started in October 2020, we had an 80% increase in switch activity on our platform. Clients destroyed more value. In that period, they destroyed 6.5% of value. We call it a behavior tax. It's the tax you pay due to bad behavior over that 9-month period due to switching.
So another risk is looking in the mirror and you see another risk, or you look at your financial advisor who advised you to make the change.
Exactly.
I think that is behavioral mistakes is definitely a big risk. Do you want to add?
Yeah, well, that talks to your opportunity cost, right? Because if they had sat through it and just kind of buckled in and gritted their teeth, they wouldn't have missed out on the opportunity of a rising market. So, I mean, there are so many examples of this, the GFC, exactly the same, right? The market crashes, everybody panics, and or they go on retirement and they are forced to take out their money. And it took a while for the market to recover. It was probably just over a year for the market to recover after GFC. But then if they had sat in it for another 3 or 4 years, I think, if I remember correctly, they would have made 157%. Yeah. So that opportunity cost, I mean, I love the Brits, right? Because if you talk to them on a Friday night and they're buying their lottery tickets and you think they'd know better about stats, and they go, but you've got to be in it to win it. and that's the opportunity cost. If you're not in the market in risky, volatile assets, then you're not going to make up that loss. So all those clients of yours, Jeanette, on your platform, all they were doing is crystallizing their paper losses, turning losses. Paper losses into absolute losses.
You only make the loss when you sell.
When you sell, but then it's too hard to get back in. Because what do you want now? You sold on very bad news. Now you want positive news before you'll believe
you want to wait until it falls a bit more, then you get it back in. And then you become greedy and...
Human nature cannot handle that decision. So you got out because of fear. But now when are you going to get back in? And it is impossible for a human person to be emotional about your losses and think, okay, but let me just go back into the market. Then you should have just stayed in.
Bonga asks, what is the most risky asset classes outside the crypto space? Let's do this one quickly. Normally, when you refer to a risky asset class, it's been, the equities seems to be that class. Is that the general perception?
Well, I mean, I would say that that is the general perception probably, and I don't know whether Anthea has a different view on it, but I think it's also when clients actually buy and sell shares themselves. So there's also, remember, if you invest in a general equity fund managed by a fund manager, at least what you get is a blend of quite a few counters, quite a few different companies that's tied up in there. Some will do better, some won't, but at least you'll get that kind of average. But if you then go and you bet your market on a tip that someone says, here's this new company coming, put all your money in there, then you just actually multiply the risk that you take because you don't have a general exposure to the equity market, you're actually in one stock.
So I think a lot of talk historically has been kind of equities are risky because they are volatile. But I think private equity is risky because it's long term, and that's back to your liquidity question. So you don't have liquidity. So when you need the money, you can't get out. And we're talking again about valuation. So probably if you have a private equity fund and you went to your asset manager and said, I really need this money, I've got an emergency, the valuation they put on your unit price in your private equity, your venture capital, or whatever it is fund is so low because you have effectively in the beginning locked up your money for 7+1 or 12+1 years or whatever the case may be. So from that perspective, I think you can probably add a few, others to risky assets. Property, again, my father always used to remind me, is only worth what someone will pay. So you could have paid 10 million and you think that the market is still 10 million rand for your house. But if you want to sell it and somebody's not prepared to pay you more than 7, that's the valuation and that's your risk. So if you look at the property index and the equity index over the long term, chances are it's gone up significantly more than your money market fund, for example, except maybe, when was it, late 90s when interest rates in South Africa were like 20% or something, right? But that perception of riskiness boils down to what you think is risky. Is risky not meeting the return you need? So for me, I've got many years still to retirement, wink, wink. But if I don't put my money in a risky asset, which is going to give me a decent return, I'm not going to meet my required return profile so that I have enough money to retire.
But
that's risky. But I've got to stay in, right? Yeah. And exactly that. If I want a return commensurate with what I think my assets should grow to, or what my liabilities are going to be, then I must take the risk, or I must be able to get out when I need the money, I should say. So different risk metrics, different styles of risk.
But there are also different risk profiles within the equity sphere. You can invest in Renergen or Orion, which are really junior mining companies. If they hit it big, they're going to really become massive. If they don't, they're going to go bust. And compare that to, say, investments in Remgro, AB InBev, BATS. That risk profile of those companies really do change.
You remind me of the dot-com bubble, right? And I feel like we're almost going through it again because, so having lived through that kind of dot-bomb era where everything just went up, I have a specific story where I looked at 2 companies and I thought, you know what? I am never going to buy books online. I love books, so that is a rubbish company never to be invested in. Look at Amazon now. Right? Whereas other companies, I thought, oh yeah, that's great for me. I want to work online. I want to deliver groceries online. That's the company I want to buy. Webvan is long gone, let me tell you. And I think when we're looking at things like our efficient frontier as asset managers, that does play significantly in our heads because we're trying to understand historic fundamentals or fundamentals based on historic data and what the outcome should be or what return we should expect from this company when it's different this time because we think the company is different. And so it's incredibly interesting for me to look through the Facebooks, Amazons, Teslas, and you think, but hang on, a company that is going to give me a decent return has got profits and, is generally on XP price earnings ratio, and that's where I should be. And then I look at Tesla or Facebook, who never made profits for I don't know how many decades, and they were the companies that actually gave me a good return. So I think that just makes our...
Yeah. Is there any scientifically proven correlation between risk and yield? Because it's not linear, especially if you look at equities. The assumption is the longer you stay in equities, the better it will be, and you will beat the yields of other asset classes. There are a few questions related to financial advisors, and I'm going to use Dinio writes here. He says, as a 25-year-old, how much risk should I be taking in my investments? And I just want to turn that question around. So Dinio goes and he sits in front of a financial advisor, and he gets that question. How much risk do you want to take? Is he able to answer that question? Is he able to perceive the absolute massive opportunity cost it may have come 40, 50 years later?
But if you're 25 years old, what are you investing for? One,
let's say long-term for retirement.
Exactly. So you're investing for retirement. So I would say, take as much risk as is suitable for your pension fund. So go into, in inverted commas, your high equity, high risk portfolio. Because at 25, you've got time in the market, right? And we want to talk about that probably. It's not about timing the market, right? It's not about should I invest today or tomorrow. It's about staying in the market and time in the market and staying there for as long as possible. The other thing, though, is that Dineo probably is going to need to buy a car, so needs cash at some stage, put a down a deposit on a house, pay for a wedding, pay for child's education. And so there's no reason you shouldn't diversify your portfolio. Like, why do you ask a question that needs an absolute answer for one investment? I mean, you've got to think about an emergency fund, a short-term fund, medium fund, and long-term fund. And again, we're talking about liabilities or cash flow, I should say, expected cash flow, right? So, and again, this is all important because a lot of people think, well, I can't invest because I'm taking high risk and it's volatility and I have to sit through it till the end. But if you've got 100 Rand, then I don't know, and I'm guessing a number, right? Maybe 80 Rand goes to retirement and 20 Rand goes to the short-term fund, which if you need it tomorrow, and it's not sitting in cash because, as we now know, inflation is eating into our cash.
How many people do that? That's what you should do. You should also have a budget.
Ryk, I really want to kind of, fly the flag for good financial advice here. A great financial advisor will firstly not answer this question the same for even 25-year-olds. Every person is unique. Look in the mirror, that person has to have a unique plan. And like, I have an advisor. In fact, I have more than one because they have different things that they look after. And this is my job. This is what I do every single day.
So you're the CEO of an investment company.
And I have 3 different financial advisors, and they look after different things. Why is that important? Well, firstly, because I have a different plan for different goals. And it's exactly what Anthea is saying, and it works out differently. So that's the first thing. Secondly, and we often say if your plan don't change, then don't change your plan. Like, it should stay the same. If this is a 40-year investment, it should stay the same for 40 years. But let me share with you just something that I think people miss when you look at it too linearly. We've stopped asking people, how much risk can you take? Because who knows? We've started doing, and we've done a lot of research on what we call advisor archetypes. And all it is advisor personality, client personalities, archetypes. So you have avoiders. They are by nature conservative. It doesn't matter that it's 40 years. They will not be able to handle it. They are so risk averse that the whole personality will force them to make stupid decisions at the wrong time because they cannot handle the risk. Then you'll have risk takers, you'll have market timers, you have people that we call anxious investors. They get very anxious when things happen, but luckily they don't necessarily respond to it. That's why I'm saying finding the right advisor is far more important than trying to understand these things. Then walking that road with that advisor. Just a piece of research that was done in Canada recently have shown that households that has an advisor over a 15-year period accumulated 3 times, 295% more assets than unadvised households. And this was done with thousands of Canadian households. Why is that? Because there's a plan, there's discipline. In order to know how much you have to have a budget. An advisor can help you with those things, and they become your coach, your kind of conscience to say, do not buy that car, or take your money out to go on that holiday. Let's remind you of your long-term goals.
And one of the issues we always have, Jeanette, is that when we get clients, one of the first questions they ask is, how much is the advisor going to charge, right? Sorry.
Yes, absolutely.
And I mean, it shouldn't be that. You shouldn't be, well, it's going to cost you more if you don't get an advisor. And most advisors shouldn't, correct me if I'm wrong, but they shouldn't charge up front, right? It's dependent on the assets under management, or how much you give your advisor and how much they make for you.
Absolutely.
More people, well, I've heard a statistic that many households do more research into the cost of a financial advisor than actually speak to other clients and make sure that it is a good advisor. But Jeanette, before there are a few questions about financial advisors. I think we've opened a hornet's nest here. What bothers me is that financial advisors do not take any risk with investors' money. They don't accept any risk for themselves. It would be better if there is a shared risk between the advice given and the actual result. That was a comment from Andre, and then Anne says, my experience has been that I follow the advice from my advisor. It seems communication from the advisor or their investment decisions affect you most if you lose money, but I'd rather be using an advisor than trying to take the risk decision myself.
Well, so my response to that would be that, remember, an advisor is not a person that kind of work for a salary. There's nothing that catch them and back them up, right? So over time, advisors build up client portfolios through looking after their clients' money, and they share in a small percentage of your kind of annual asset growth. So maybe it's not that they're going to write you a check to kind of, cover the shortfall, but what they are going to do is that their income's also going to decline if your asset base is declined. So in an indirect way, they are affected by it. And that is also why it's so important for advisors to remain in contact with their clients, to avoid that their client make a decision that can cost them 33%, of their assets because they made a rash decision. And that same study that I've referred to now, I've actually shown that it's the same Canadian market, it's the same study, that just by being the behavioral coach, so what they did was they isolated decisions clients was about to make and their advisor prevented them from making it, added 3.5% to client returns. Just by being your coach that says, stop, we have a plan, let's stick to our plan, 3.5%. That 3.5%, your advisor is not getting paid as a fee, you don't write them a check for it. But it saves you that 3.5% of your capital you would have lost if you made that decision instead of listening to your advisor. So I do believe that advisors add value. The right advisor that is aligned with you.
The key word there is the right advisor. A poor advisor is the biggest risk you can probably have.
No, absolutely. Shop around. Ask people you trust. I tell you what, there's a study that says we all hate advisors, but we all love our own. Like, you know what? I tell you what, if you ask me for a recommendation, I'm not going to recommend you someone that I haven't walked the road with, someone that I know, and like, our friends and family, I'm sure they can tell us who, do a good job for them.
Maybe we are digressing a bit, is that most people would recommend an advisor because he or she is friendly and there is regular communication. It's difficult to compare the performance of an advisor because people are so different.
Indeed, I mean, it is very difficult. I must admit, I agree with Jeanette. Like, I have a couple of advisors who I recommend because I know they're good, because I know that if I need them, they are there, they've done their homework. And so what you're looking for in an advisor is somebody who can tell you about the different types of assets or portfolios, I should say, that are available to you. And I mean, there's an obvious one, right? You can check the FPI website, right? It's fpi.co.za. It's
FPI, not FBI.
Yeah.
Financial Planning Institute.
Looking for something different in the FBI website.
But I think what is so important is interview that advisor. Ask them. You wouldn't go to a doctor and just kind of walk in. Ask them, What is your value proposition? What can I expect from you? How often will you communicate with me? What will happen if my portfolio fails? Like, I think you need, why are we too worried to ask the same questions to a person that we're going to entrust with our life savings? Why are we too afraid to ask them how much they're going to charge us and what we could expect for it?
I was going to add to that the chasing of returns is a big risk in itself, because what people do is that they want the big return. So if you go to the BRI, everybody's talking about, oh, my crypto or my gold fund or my equity fund my offshore fund was up 30%. Now, if you're chasing returns that are not commensurate with how the market is performing, you must understand that there is risk involved in chasing that. And that's how people get caught in Ponzi schemes, right? So they don't go to the FPI or the FSCA website. They just chase the highest return that their friends were saying to them, oh, I bought this and got this return. And this is where financial planners are much more savvy than your mates around the BRI, I'm afraid, because they know the association, or they should know what is associated with the return that you are chasing or that you require versus what is actually attainable in the market.
Yep.
Herman says, it's easy to say if you cannot take risk, you should invest in lower equity unit trusts. Yet the pure equity funds have outperformed low equity funds and balanced funds for 5 years, 3 years, 1 year, and 6 months. So what is past performance of asset classes and asset allocation tell us about risk?
I want to get back to the first statement I made. Yes, it is absolutely true. You look at the historic returns of these different asset classes, and it is absolutely true that over the long term, equities will outperform and have outperformed for the history of the world, these other asset classes. My question is, how many clients got that return? Because how many clients were actually able to get in and stay in? And I think that's the crux of the question an individual need to ask themselves. And that is where, your first question was, should I be in an equity fund that can give me 10, or is it better to be in a less risky fund that gives me 8? I would almost say human behavior will tell you, be in the one that gives you 8, because you might actually get the 8. The 10 you might never get, because the 10 might be 10 today, minus 20 tomorrow, and plus 30, because all you see is the average over time. What you do not see is the volatility of that fund. That's the question you need to ask yourself, but an advisor can help you to answer that question.
And as I pointed out earlier on, the market is so set up to help investors do the right thing as long as they can quell their inner kind of demons, right, and handle the volatility. Because, again, we use the efficient frontier. We understand historically where each asset class lies on that efficient frontier. And for X amount of risk, you can potentially get this amount of return. It does change, so we have an efficient frontier model in our office, and we look at it and we keep looking at it, because historically it has changed. It will, because not everything performs perfectly. The JSE, if you looked at it 4 years ago, was on average returning 16% per annum. Now suddenly it's returning, I think it's like 12 or something ridiculous. Maybe that'll change in future, but it's that volatility that you have had to sit through that brings you to back to that 16%, I think, that you're looking for or that you wanted from the JSE. Now, if you are 64 and retirement age is 65, then maybe you don't have enough money. Should you be taking more risk? I think that is kind of quite an important question we need to cover. Should you be taking more risk? But if you are forced to take more risk, in other words, be in a higher volatility fund,
and stay there.
Is your risk at 65 going to be that fund has plummeted 30%, and so you're from a year ago you're 30% short on your target retirement fund? I think that's almost the more important question of what is my target and what are my targets, because there are short, medium, and long-term targets, and how am I going to get there?
But nowadays, when there's actually a seamless kind of process between pre and post retirement, that most products don't force you to say, oh, today I'm 65, I've got to sell all my investments and go invest in something else. You can continue with those investments. And I think that's another kind of mistake people often make, to think, well, what I do up to the day of retirement need to be completely different to what I do after. Why doesn't it need to be? Because your time horizon is again another 30, 40 years. With longevity and how long... No, it's not a dead end or a dead stop. So for 40 years, I've been building up my wealth. Now I have it. Now I'm forced to go into a different instrument that's now maybe going to pay me an income. But you've got another 40 years, at least 35 to 40 years ahead of you. So your time horizon have not changed. The problem is if you are on a product where you're forced to kind of turn it into cash today and then go back in the market tomorrow. But 99% of products now with in-fund retirement and preservation and so on, you actually don't even need to do that. So your portfolio doesn't end on a specific day just because it was your birthday. You can seamlessly continue and over time change the kind of underlying portfolio.
There's a question, nobody wants to lose money, and it's difficult to sit on your hands. And you know, I get a report every day of my investments, how they performed the previous day, and some of them are really long-term investments, and it's really not nice to see a red number. So I just stopped looking at the email, and I think ignorance is bliss, especially if it is a long-term investment. How do you mitigate risk through asset allocation? Is asset allocation a critical part of managing risk, especially if you're 25 years old and you've got a 45-year investment horizon? How should you look at that?
I would say it is important, but probably more important is managing your liquidity risk, right? So what are your liquidity requirements, rather than should I be in equities, commodities, property, fixed income? Like, should I be in short, medium, or long-term style investments? Because along with the risk metrics that, every at the top of every fund fact sheet, it's low, moderate, high risk, right, and two in between. Surely that would be an indicator of the volatility of the fund, and therefore also an indicator of liquidity. So I would say if you're thinking about mitigating risk through diversification, which is really the question, then maybe look at that rather than should I be in gold, property, commodities, equities, or fixed income.
We can just actually look back at the flows into unit trust funds over the last 10, 15 years or so. And by far, your asset allocation funds, where you actually leave the asset allocation decision to the actual fund manager, your so-called balanced funds, stable funds, or high, medium, and low equity multi-asset funds, have attracted most of, if I say most of, it's probably 80% plus of the flows in the industry. And that tells you something about people's ability to sit in an equity fund and or, kind of keep their money in the money market, which is actually in the long term the worst decision, by the way, because inflation is your biggest enemy there. But rather put it in a type of a asset allocation fund where your fund manager make that decision on your behalf. Sometimes there'll be maximum in equities because it's cheap, it's the right time to buy, and they're a little bit less emotional about your return. And in other times, they will de-risk the fund simply because the market's high. They kind of, cash in some of those profits, de-risk the fund a bit, and then kind of go and invest in the market again.
There's a question related to the risk profile of different funds, and I think it ties into what you've just said. How much more risky is pure equity funds versus multi-asset funds?
Again, depends on your time horizon.
Say it's 10, 15 years.
Time horizon. In 10, 15 years, and it's the right 10, 15 years, your equity fund's probably going to outperform your multi-asset, asset allocation fund by a 3 or a 4%. It could be more, and times, it's a lot more than that. Again, it depends on whether you could stay in for that period of time.
And I would say that it also depends on the style of investing. So you could have a pure equity fund that is invested only in small caps. Now, I would say that is incredibly volatile and incredibly risky.
Correct.
Because of its volatility, as opposed to
the top 20 fund.
Exactly, which potentially is less volatile, or historically, not potentially, historically less volatile. So again, there's absolutely no need to have all your eggs in one basket. You do not need to have all your funds in a high equity fund or all your eggs in a money market fund. There's so many different ones in between that the industry, and we keep talking about unit trusts, there are thousands literally of unit trusts in the country, and it's because the industry has made a point of accommodating everybody and giving everybody the opportunity to diversify across the risk spectrum. So 25, I think it was Daneo, that was 25 years old. Sure, you have the ability to sit through long-term, another 40 plus years in some of that money, but some of that money needs to be short-term. So some of that money,
your car breaks down.
Right.
Emergency fund.
You need a fixed deposit, or you need a money market or an income fund that is not as volatile, so that when you need that money, it hasn't fallen 30%.
Our number is 3 times. We say that you need 3 times your monthly salary in an emergency fund. Then you're probably safe, and safe enough that if you need cash quickly, that you can access it. So, if you have about at least 1 month's salary, but 2-3 times a monthly salary in an emergency fund, which then is as close as cash as you can get it, actually is quite a safe way of then just de-risking that kind of life happens to you and you have those emergency funds available.
Yeah, absolutely. And it reduces your personal risk.
It does.
If your car breaks.
And stress.
I was waiting for this question. Busi asks, how do I assess company-specific risk in my investments? Does a company's lack of future growth outlook affect its value? I just want to, that first question, Steinhoff, Tongaat, there are company failures, big ones, and within, weeks and months before those companies crashed, professional investors were still investing in those companies. They couldn't even pick it up. Yeah. So how do you assess company risk?
I really want to cut Busi short and say, why are you even trying? If professionals are struggling, professionals who look at the market and look at companies every day, who have teams of analysts.
All we do.
Yeah, are unable to pick up certain things, then why are you as an individual investor trying to do that? Now, I must point out that I think Steinhoff was fraud. That's kind of my call on it. And no matter what, it was very difficult for analysts and fund managers to pick up. So when you're being lied to, that is it. Like, how do you know you're not being lied to? It's going to take something quite special to figure that out. But then there are other, there's kind of African Bank, which the writing was pretty much on the wall. And again, even professionals got caught in it. So, Busi, very difficult to give you an answer. We spend our lives looking at it.
No, I appreciate that, but many people work for a salary. Their pension goes off their pay slip, and that contribution goes to a company and has been invested, and that is long term. The only way you can really, screw that up is if you take that money when you leave your job and you resign. But many people also want a discretionary portfolio. So that's, I think, the purpose of this conference as well, is to help people like Busi to go and try and get some skin in the game, get some exposure to how the market works, and then suddenly you look through a totally different set of glasses at your performance of your portfolio, where the professionals invest. A lot of people go to a restaurant and they order the oxtail, and then they said, listen, my mother's oxtail is a lot better than this one.
I think the way you should look at it, if you have the time to do the research, if you have the time to really study those companies, I think take a little bit of playing money. A little bit of money that if you lose all of it, it's actually not going to destroy your entire financial future. So start with your emergency fund. Then have your pension portfolio looked after by a professional. And take that percentage of your bonus every year and see that as your gambling money. Because then the possibility is there that you could wipe it out. But if that doesn't destroy you financially, it's a fantastic way to get into the market and to learn.
I love that people are looking at investing directly. And from that point of view, I have to say diversification, right?
Yeah.
So if you've got 100, if you had 100% in Steinhoff, well, you were like, it was crazy. Like your fund manager is never going to put all your money into Steinhoff. But if you had 3% in Steinhoff, or you were close to even kind of the market allocations or weightings, then sure, you would have lost some money, and yes, it would have hurt. But on the flip side of that, you would have been in Naspers at the time, which rallied and probably tripled your money. So diversification, if you're going to do it yourself, diversification is absolutely key.
Yeah, and I think try and get research. I think the more mistakes you make, the more you learn. And my biggest investment lesson I've ever learned, I believe it's a degree in investment management, was when I lost a lot of money. And I think you can learn through that as long as you don't really get financially hurt by that. You need to be able to afford that loss, and don't take positions where you're not in that position. Just lastly, a last message for Dineo. Again, we've spoken for close to an hour. In one sentence, how should he approach risk? Is there a homogeneous one sentence, one paragraph answer to that question?
So I would have to say that you have to do a budget and you have to diversify.
I would say look in the mirror, understand your own dreams and your own nightmares. You need to know the dream is the goal, but you need to understand when that turns into a nightmare, what does it mean? And I think it teaches you a lot about yourself and your ability to then make the right decisions and stick them through. Time in the market.
Yes, and I think emotion is also a very big risk. If you are an emotional person, take that into account. And I think this was a fantastic session. Anthea, Jeanette, thank you so much for your participation. And yes, I think risk is a critical element everyone needs to take into account when they invest in a portfolio. And I think the main takeaways from this session is, listen, take decisions based on facts. Let emotion not dictate any of those decisions, and stay in the market. Don't have a knee-jerk reaction. Stay there, you will profit.